Markets want to know that there's a hand on the tiller of inflation, not in just the short or even the medium term, but the long term as well. And that's going to be separate from the necessarily shorter term agenda of an elected politician working on a 4-year presidential cycle. Hello, everybody, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined today by Tom Stevenson, Investment Director here at Fidelity. And we're going to be talking today about the possible reasons why the current strong run for stock markets could come to an end. We've already had a near miss this year with drops in the market caused by the announcement of trade tariffs, of course. Markets quickly moved past that and have gone on to new highs since then, but there remains a high level of nervousness about the sustainability of the market at these levels. So, Tom, welcome along. How are you?
I'm very well, thanks, Ed.
Good. Nice to have you back on the podcast after a few weeks away.
Yeah.
Now, there's always reason for pessimism in markets. In fact, if there weren't pessimism, that probably itself would be a sign of something to worry about. But it's fair to say, isn't it, that people seem on the hunt right now for the thing that's going to kill off this bull market?
Yeah, and I think the reason for that is that there's this sort of slightly curious mismatch at the moment between the stock market's sort of unbridled enthusiasm and optimism and everything else that's sort of kind of going on at the moment. I mean, if you look at what's happening in the world, especially with, tariffs, with sort of anxiety about, central banks and what they're going to do with interest rates and, and other factors that I'm sure we'll come on to do with the independence of those central banks, there seems to be a gap in the middle between what's happening in stock markets and what's happening in the real world. And I guess the other thing is this bull market's just been going on for a long time. Even just the sort of, the sort of in the short term, markets have been rising for nearly 3 years now. They bottomed out in October of 2022. But if you look on if you step back a bit further and markets have really been rising since the financial crisis, which is now, that's 16 years ago now. So I think if people look at the history of bull markets, they might come to the conclusion that this one is getting a bit long in the tooth. It's been running for quite a long time.
Yeah, and I think for a lot of people, we saw what happened this year when the tariffs were announced, imposed, on, off, all sorts of, toing and froing about tariffs. And a lot of them were removed, but not all of them. And a lot of them have now been imposed. And the market's kind of decided that it's not going to care that much about that.
Yeah.
Obviously, there was a reason for markets to fall in response to tariffs, but the market doesn't seem convinced about the end sort of ramifications of them. And so it's chosen to look on the bright side.
Yeah, it's kind of looking at the glass as being half full, even though, as you rightly point out, the tariffs, they've been on, they've been off, they've been pitched at very high levels, they've come back to less high levels, but even the less high levels at which they seem to have, settled, that's still a lot more than tariffs were 6 months ago at the beginning of the year.
Yeah.
So I think investors have been sort of studiously looking for the silver lining and
finding it,
finding it and ignoring the cloud around that silver lining.
Yeah. And we're here today really to look for kind of culprits, as it were, the things that might come along and kill off this bull market. What is that quote, Tom? Remind me that bull markets don't die; they tend to be killed off, right? And one of the leading culprits will be the Fed and interest rates, monetary policy. We've got a big moment coming up in about 3 weeks, I think, when the Fed will meet to decide on rates. It's expected to cut. It'll be a very, very closely watched interest rate decision for all sorts of reasons. Why is it such a crunch moment?
Yeah, I mean, the Fed will make its decision on interest rates on the 17th of September, so in about 3 weeks' time. And there's been a bit of to and fro as to whether the Fed will cut interest rates. You've got to remember that the Fed has not cut interest rates since last December.
Yeah.
So it's been a very long pause. And the reason why there's been this long pause is because the policymakers in the Federal Reserve have been watching and waiting to see what the impact of tariffs is likely to be, because the Fed has a dual mandate. It's tasked with keeping inflation in check, but also working towards maximum employment. So it's got a growth focus and an inflation focus. And at the moment, those are kind of contradictory, because interest rates have been high. That would be expected to have a dampening effect on growth, on economic activity.
Mm-hmm.
But at the same time, we've got these tariffs coming in, which are expected to be inflationary. So I think the Federal Reserve has been right to be cautious and to say, let's just wait and see which way this goes. But it seems that they're starting to come to a conclusion.
Yeah.
So we had this meeting last week in Jackson Hole in Wyoming. It's this meeting, a summit of central bankers. It's always watched very closely to see what the Federal Reserve Chairman Jerome Powell has to say. He kind of indicated that he thinks that we're at a bit of a turning point.
Yeah. An economic symposium is the grand.
Is that the grand title?
Yeah. Which is a grand title for a load of meetings and seminars and lectures.
A lot of people
speeches.
talking about stuff.
Yeah, exactly. Yeah. And Jackson Hole, by the way, I always think this absolutely lovely. Jackson Hole, it's a beautiful place, isn't it? They always pick these very lovely locations for their.
It was a very interesting. I mean, just 30 seconds on this. It's a very interesting story about Jackson Hole. Why they're in Jackson Hole?
Yeah.
Because I mean, this symposium has been going on since the late 70s, and in 1982 it's organized by one of the regional Feds, Federal Reserves, the one based in Kansas City. They wanted to get the then chairman of the Federal Reserve, Paul Volcker, to come along to this symposium. He was a very keen fly fisherman. And so they thought, well, do you know what? If we want to get the chairman of the Fed along, let's hold it in a really nice fly fishing resort, which Jackson Hole is. It's in the Rocky Mountains in Wyoming.
It's gorgeous. It's really lovely.
And it's absolutely beautiful. And funnily enough, they've been there ever since.
Yes, we're not here to talk about that, though, Tom. But it is a good little diversion. Yes, we had Jay Powell talking at Jackson Hole, and it's all very balanced, isn't it? The way they talk, he's saying that monetary policy at the moment is restrictive, so which means it is doing its job of pulling in inflationary forces. He's also spoken about what the impact of tariffs might be. It might be a one-off thing. They might sort of tolerate that, but then it might be something that turns into a longer term thing, and they wouldn't want to tolerate that. It felt like, and certainly looking at the market reaction, it felt like the market got what it wanted, which was a kind of yes, we're probably going to cut in September, but there's still some more data to come, so hold your horses a bit. But
I think they got a bit more than they expected, actually, because I think that in the run up to the Jackson Hole meeting, there was a lot of talk that Jay Powell would be talking about the sort of framework within decisions were made. He actually didn't talk very much about that. And he talked more specifically about the short term, what will happen at the next meeting than I think people had expected. And the message he gave was pretty clear, that growth is beginning to slow. He's beginning to see that in the data. He's very data dependent, or rather the whole committee is very data dependent. So he's saying we are beginning to see that impact in the data. So therefore, I would have thought, all other things being equal, and there are a few things to happen between now and September the 17th, but all other things being equal, we're probably edging towards a time to resume that rate cutting cycle.
Yeah, and that seems to be what's happening in the commentary. People always put figures on the kind of odds of these things, and it's about a 75% chance that we will get a cut. But inflation is still above target. And so we've got a similar sort of situation here in the UK. Inflation above target, rates are on a downward trajectory, but yet inflation is stubbornly high. So it's, if we're putting this in the context of things that might derail the stock market, clearly any kind of any hold at that meeting is going to upset the market quite a bit versus its expectations now.
Yeah, I think now, especially after Friday, it would have a particularly detrimental impact, because I think the market has convinced itself that actually we are going to get a quarter point rate cut. So I think if between now and September 17th, we've got another. Well, this week we've got a one inflation measure, which actually is the Fed's preferred measure. It's called the consumer personal consumption expenditures index, PCE. That's actually the Fed's preferred measure of inflation. That comes out on Friday. And then in a couple of weeks' time, we've got the more normal mainstream consumer price index, the CPI. We've also got some jobs figures coming out. So in the next 3 weeks, we've got both the growth numbers and the inflation numbers. So it's not a done deal. If they're not what the market expects or what the Fed expects, then it is possible that the Fed will stay on hold.
And to clarify those points, if those inflation measures come in higher, or if the jobs data is actually stronger, i.e. more positive, more jobs, that would also potentially stay the Fed's hand.
Yeah.
Although we are expecting a cut, we should say that. And where that cut would be very, very welcome is in the White House. Tom, you wrote this week, you said that that the White House's, quote, undisguised irritation at rate cuts not having happened sooner. That's an understatement, I would suggest.
Yeah, it is. I mean, this is, the relationship between the White House and specifically the president and the chairman of the Federal Reserve, Jerome Powell, is, there's never been a worse relationship that I can remember between these two figures, and the at the heart of it is a disagreement about interest rates. The president wants to promote growth in the economy. He wants to bring interest rates lower, and that would have the effect of bringing the dollar lower, which is also tends to be good for growth in the American economy. So he's going all out for growth. And the Fed chair is saying, well, that's not my job to just promote growth. I have this dual mandate. I need to think about inflation as well. So, the president has been, pretty blunt about what he thinks about Trump. I mean, he's actively speculated about whether he would sack him.
Yeah,
there is a question mark about whether he even has the right to sack the.
Jerome Powell has said he does not have that right.
He says he doesn't have that right, and indeed his term runs out next May. So whatever happens within the next 7 or 8 months, there will be a new chairman of the Federal Reserve. But the relationship is very poor.
All these things, I believe, are kind of connected. We've spoken about tariffs, interest rate policy, growth, this sort of drama that's playing out between the two institutions, White House and the Fed. I think when the tariffs were announced, the expectation was that it would be inflationary and ultimately would hurt growth and would feed through in economic figures. Donald Trump doesn't want that to happen, clearly. Tariffs are a huge part of his agenda, like probably the main part, you would say, maybe the immigration stuff and this. And he wants there to be good growth despite the tariffs. That means he's won that argument, he would see it. And he's putting pressure to kind of get that outcome. Maybe the Fed, well, I don't think the Fed would be acquiescing by cutting rates next month. I think that would always be part of their picture. But it's not just the kind of public criticism of Jay Powell, is it? There's this remarkable situation with another of the governors at the Fed being accused of some kind of mortgage fraud and potentially put under pressure to leave, and she's resisting that. It's probably not for us to go into the ins and outs of all that, but we can talk about the principles of central banking and why it's good to have an independent central bank. What is the received wisdom for keeping central banks separate from the executive branch of a government?
Well, it's all about credibility, because if the central bank is seen to be, if you like, in the pocket of the White House, then that cast doubt on its determination to get on top of inflation. That in turn will be reflected in the bond market.
Yeah.
Because if investors are unsure how committed the Fed is to controlling inflation, they will demand a higher return to compensate them for that risk. So that will push bond prices up. It will have an impact on the dollar as well, because that's all, the value of the dollar is all about trust and credibility. And why this matters is because the US Treasury market and the US dollar are the sort of underpinnings. They're fundamental pillars of the global financial system.
Yeah.
Now, so the Federal Reserve was given its independence back in the early 1950s, and most other central banks, most other countries have followed suit. And so it has become the norm for central banks to be independent of governments. And so it is very important. So what we're seeing at the moment is the most determined, concerted assault on the independence of the Fed. And why this, you mentioned this, the latest development of the president's attempt to fire one of the board members, the governors of the Federal Reserve Board. Why that matters is because if she does go and is replaced by
a pick of his,
then effectively the White House then has influence over Federal Reserve policy, because it will have a majority of those governors.
Yeah, I mean, I guess markets want to know that there's a hand on the tiller of inflation, not in just the short or even the medium term, but the long term as well. And that's going to be separate from the necessarily shorter term agenda of an elected politician working on a 4-year presidential cycle, who's going to want growth in the here and now.
Yeah.
But possibly at the risk of inflation, and were the bond market in particular to become unconvinced that firm hand was there, and that the Fed was now acting, in fact, more according to a short-term agenda, it might say, well, this is going to be inflationary, and these bonds, these treasuries that we can see paying this amount of yield, we suspect that's going to be higher in the future. So we're going to sell those treasuries and wait for them to rise. This is what happens in the bond market. The sort of the speed and the power with which it can act when it loses faith.
When you can see that in the UK at the moment, the yield on long-term 30-year government bonds in the UK is rising and rising. So week after week, 30-year bonds are now yielding about 5.5%. And the reason is that the bond market is testing the government. It's saying that they are unsure of the ability or the determination of the government to get its finances under control.
Yeah.
And to understand the importance of this, if you roll back to the early 1980s, when that Fed chair that we talked about before, Paul Volcker, with regard to Jackson Hole, when he was able to stamp out inflation, which had gone mad in the 1970s, he was only able to stamp out inflation really by ratcheting up interest rates to a very, very painful degree.
Yes.
Now, if that, if he hadn't had that independence, if he'd been effectively an arm of the government, it's extremely unlikely that any politician would have wanted to do that, would have been prepared to do that. So what would have happened then? Inflation would have, could have run out of control then.
Yes, and we're here to talk about potential risks to the stock market. I suppose this is very hard to kind of make any predictions about. Probably, if any of these real dire circumstances come about, several very bad things have to happen before we get to that point. But ultimately, something going wrong in the bond market, the need for higher rates at that stage, it would clearly be really injurious to the stock market and to growth in general, which of course is bad for the stock market.
And in particular, I think it would be bad for the stocks which have really driven the stock market. So if interest rates were to stay higher for longer, that would be bad for the tech stocks. Because they really thrive on an environment of low interest rates.
So
And
much of their
yeah,
price is based on these future earnings that
exactly
that
right.
are being banked on, basically.
Yeah.
And inflation and higher rates hurts that. Um, there could be, Tom, yet another different potential threat to stocks, and that might even arrive this week. It might even have happened by the time people listen to this podcast, and that is that Nvidia is updating the market on Wednesday evening, I think.
It is, yeah, Wednesday evening, yeah.
UK time.
Yeah.
Um,
Well,
is-
actually, US time, because after the market closes, so it will be, yeah, so that's even later, isn't it? So that will be
Sure.
late in the evening on Wednesday. Tomorrow.
Okay, and it matters, of course. It's the biggest company in the world, so that would always matter. But it is, of course, something of a proxy for the success and the profitability, more importantly, of AI as a whole. So it really matters what these numbers show. The market's betting on them being good, right?
And I think they will be good. The expectation is that Nvidia's quarterly revenues will be, I think the figure is about $46 billion.
Decent.
Which would be decent, yeah, and it would be a 53% growth rate year on year, which is actually less than the growth rate in the prior quarter, which was about 69%, I think. But a 53% growth rate for a company as big as Nvidia is still pretty amazing, and it's way ahead of the rest of the market. So it is still, it is still driving the market. But in recent weeks, there have been some real concerns about the sustainability of this AI boom. Will the profits really be generated to justify the huge amounts of investment? So I've read this morning something like $350 billion is going to be invested by the likes of Meta and Google and Amazon in AI capability. It's reminiscent in a way of what happened 25 years ago when huge amounts of money was thrown at the internet infrastructure, and a lot of resource was misallocated. A lot of money was lost, and I think that is the concern. Is everyone's got very enthusiastic about the potential for AI. They're now starting to look at the possibility for that money not being well spent and money being lost.
Yeah, and actually, this is a topic that Gemma and I spoke about on the last episode. If people want to go seek that one out, but there was a report. I think it was an MIT report, which ultimately knocked those shares back a bit. And basically, it said that in the real world of businesses out there doing their trading, they were finding that the investments they had been making weren't as profitable. Sorry, the investments in AI that they were making weren't sort of corresponding and translating into profits in the here and now. And that's actually where the rubber meets the road with AI, doesn't it? It can be fantastic technology, but if it's not going to make not just companies like Nvidia more profits, but actually all the other companies and individuals that will use it, if it doesn't improve their sort of lives and profitability and productivity, it will not be delivering from an investment point of view.
Yeah, and this is why this parallel, this comparison with the dot-com bubble 25 years ago is very instructive, because then the real beneficiaries of the internet were not the companies that built the internet infrastructure. They were just ordinary companies that were able to harness the internet to make their businesses more efficient, more profitable, and to open up new markets. And I think the expectation is that AI will do something similar, but it may not. And so there are two things. One is we don't know who the beneficiaries will be. It probably won't actually be the Nvidias. It will be other companies that harness AI. So that's one uncertainty, who those companies are going to be. The other uncertainty is whether it will actually happen.
And when, you might, because a lot of the potential of the internet really was unlocked
delayed,
by smartphones and what have you. Later,
it took something else.
It took something else
to catalyze it. Yeah.
Look, before we go, we've been really negative, Tom. So I want to end on some positivity, and in particular, think about what investors could do, should do about all of this, because I said at the start, there's always predictions of trouble around the corner in stock markets. You could have made many of these arguments at different points in the last 6 months, 12 months, 18 months, and you would have lost loads of money by doing that. Given that context, what should investors do with this information?
Yeah, and again, I draw a parallel with the dot-com years, because I think once that bubble started bursting, I think it would have been very easy to get yourself into a negative mindset and to think, oh, this internet is a waste of time and it's not going to change anything.
Yeah.
And of course, the reality is it did completely change the world and made the business world much more efficient and opened up new markets, as I say. AI will undoubtedly, it will probably do something very, very similar. And I think, I was referred to this expression, the triumph of the optimist. I mean, this is the stock market is an illustration of that triumph of the optimist. That all of this endeavor over the years grows the size of the economy, it grows the investment opportunity, and the markets go up and down, but over time they do tend to go up. So how can you mitigate the risks? Well, you can mitigate it in all the ways that we talk about a lot, about diversifying.
Good time to sort that diversification out before any real strife in the markets.
Very good time. Absolutely the right time to do it now, because you're probably sitting on some quite good gains from your investments. The value of your portfolio, your pension, whatever, is likely to be at a good level. Now is the time to, well, as they say, fix the roof while the sun is shining.
Okay. Well, that is all the time we have for now, Tom. I'm just going to remind everybody that if you found any of this interesting or useful at all, that you can subscribe to the channel, and that's going to ensure that you get updates like this as soon as they are released. You can like the content, you can take part in the comments as well. That all helps people find this content. That said, Tom, thanks for joining me.
Thanks, Ed.